Good afternoon, everyone, and welcome for this webinar on the Swiss climate scores. This is a great opportunity for AMAS and SSF to introduce the second version of the template established on the basis of the updated version of the Swiss climate scores published by the SIF in December 2023, and which will replace previous version by January 2025. Thanks so much for attending in numerous numbers. For this webinar, we've designed a program whereby Adrian Schatzman, CEO of AMAS, will first start with some opening remarks. We'll then hear from Christoph Baumann with some perspective on the context for the Swiss climate scores in Switzerland and beyond. We'll then deep dive into the tool, into the Swiss climate scores template, together with me, and importantly, we'll hear from practitioners about how they use the scores on their day-to-day. What are the challenges that they're also facing on the practitioner side? And this panel, comprised of Ruben Feldman from the Zurich Cantonal Bank and Barthélémy Simon from Lombard Odier, will be moderated by Sabine Döbeli, who will then close this webinar. So you can ask questions via the chat, and there'll be room for your questions at the end of the webinar. With no further ado, I'll hand over to Adrian.
Thank you, Aurelia, and good afternoon, everybody. This is now the Swiss Climate Scores version 2.0, and for all of those of you who were here already last week, this is also our second webinar on this very important update. What I think is important is not only that we have evolved. We have always said that the Swiss Climate Scores, this is a journey. We started a while back. Today we discuss an updated version, and I'm very sure we will discuss a more advanced version sometime in the future. But it's important not only because of the additional criteria, but also today we're going to discuss the underlying templates. And that sounds sometimes a little bit boring, but I can tell you it's probably the most important thing we do here. If the Swiss climate scores do not allow for comparability, if they're not applied in a consistent manner, we would lose out on much of the importance of and the power of these scores. One point that I think is very important, we're probably here among ourselves, most of us are very close to the topic. I would consider this as a circle of experts, but eventually we don't do this with climate scores for us, for the industry. We do it for our clients. And we can only make the Swiss climate scores relevant for our clients. We can only achieve impact with these climate scores if we find the right language, if we make sure that our colleagues who are on the advisor side feel comfortable with these climate scores. So please make sure that you spend time with your colleagues, you use them as a multiplier, and make sure if education is needed, you provide that for your colleagues. And lastly, probably the most important still today, a very big thank you to everybody who helped establishing this second version of the Swiss climate scores. A big thank you also to Sabine, to the Swiss Sustainable Finance. Again, we have collaborated here very closely. It's almost a tradition that we do things hand in hand to make sure there is one standard for the whole of Switzerland. But I would also like to thank you, Christoph, the whole team in the SIF, for the open doors, for the regular exchange, for the honest exchange. A lot of us probably take it for granted that we have such a close dialogue with the federal administration, but I can tell you it's not. It's a privilege to work so closely together. And to me, this is again the result. This climate scores result, the quality of it is also is again not possible without such a close collaboration. So a big thank you to everybody. And with this, I hand back.
Hello, everyone, and thank you very much for inviting me to speak and talk about the Swiss climate scores and the updated version. Also, thank you very much, Adrian, for your kind words. I fully share your view that only when we can make the climate scores as comparable and as possible, when they become actual decision useful information, then we made the Swiss climate scores a very powerful tool for the climate transition of the Swiss financial market indeed. And I would start with the background of the Swiss climate scores. It's obviously on the one hand, you have the Paris Agreement 2015, the Article 2.1c, the famous one to align the financial flows with the goals of the Paris Agreement, but you also more recently you have the Climate and Innovation Law, which came into effect after the popular vote last year, which has in Article 1 to align the financial flows with the net zero goal of 2050, and Article 9 to have the government ensure that the financial institutions actually contribute to climate change. And I think it's really important when you have this overall mandate that you also have a common understanding, well, what does it mean to be aligned with the climate goals? It's not that easy to have a view over the next 27 years or 26 years until 2050. It's quite a complex matter, but we need to have a common view to really have the right incentives for the market to change their behavior or to implement their preferences towards climate alignment. And therefore, we sat together with the NGOs, with the academics, with the industry, and with other federal agencies such as the Environment Ministry, and we worked together to establish a way to what does it mean to be aligned, which is forward-looking. We really believe that you cannot just look at what the company state is today. You really need to look at what is their transition plan. Do they have science-based targets to reach net zero? How are they aligned compared to other companies and other similar companies of the similar sector? And this is what the climate scores do. And also to give you a view of what the asset manager is doing with these companies in the portfolio. Is there an active engagement, active stewardship with these companies? So all of these things, they're condensed into 6 indicators in the climate scores. We now added with the revision a layer of helpful guidance to the financial institutions to implement it, to ensure that the implementation is even more efficient, but also more comparable. And also in line with the Swiss Federal Council's position on greenwashing, we also added an overarching question on, do you think as an asset manager, is this portfolio, is this aligned with climate, or does it even contribute to climate? So does it have an impact characteristic as well? We are very happy with how we see now the adoption in the market. The most recent numbers from the Swiss Sustainable Finance Market Study indicate that a quarter of the industry has already implemented it. Another quarter is planning to do so in the next year. And this is exactly what the Federal Council wanted. We wanted a tool for the ambitious institutes in the market to have a common tool. It's a voluntary instrument, so it would be surprising if then in the end everyone implemented it. It's really meant for the ambitious institutes, and there we see great traction with them. Where do we go from there? Adrian said it correctly. It's not set in stone because the entire sustainable finance dynamics are very high. Yet, obviously, it's a focus, and certainly now after this revision, the focus is on stability to really facilitate implementation in the market. So we do expect it to stay reasonably stable, but we're very up for, especially since we know that the current climate scores are focused on global equities and bond portfolios. We're very up to that over time. We discuss an extension to maybe sovereign asset class or real estate asset class, or even to look at the topic of nature. So this is something which, together with the industry, academics and NGOs, we can discuss over time to expand. But I think in certainly the focus for now is on stability. Thank you very much for that.
Thank you very much, Christoph. We'll now move to the deep dive on the template itself. So I'm happy to introduce you to the second version of the template. As we mentioned, as AMAS and SSF, we definitely support the initiative of the SIF to establish such standard for the industry based on internationally and widely recognized indicator, which in our view really pragmatically measure the way financial investments are actually compatible with the Paris Agreement. And so with the template, it's been said, we really aim to support the implementation of the standards across the Swiss asset management industry. The key value added of the template is really to establish a standard that is applicable for all the industry and that is has consistent wording, consistent calculation, but also consistent way to disclose. And the idea of the template was really built around that in order to ensure the maximum comparability across portfolio, across institutions. So that's really the spirit behind the template. The template, you can now find it on both AMAS and SSF websites, so feel free to use it. And it's been said it's a journey. Flag to us any kind of questions or feedback you may have. This tool is really aimed to be adapted and amended over time based on the experience of the practitioners. So with that, I'll now deep dive into the tool itself. So here you can see basically some of the screenshots from the template. We still have, we still use basically the same Excel based for the template. The reason for that was really that we believe having access to the formulas, etc., makes it easier for practitioners to really understand. This time the template is fully open, so we have not protected the file on purpose. That's intentional because we had a lot of questions obviously on how the formula were working, so we left it open intentionally. Obviously that means that any user also use it with its own responsibility when it comes to changing anything on the template. So we still propose a summary sheet that basically offers the possibility to show the indicators in 2 pages, so across the different portfolios. So here it looks very empty because there is no mock portfolio behind. Again, this the summary sheet is only a suggestion, and that it can be definitely adapted by the institution, by practitioners based on their own needs, and that's already currently the case. What is important and what needs to appear is in terms of display is that indicators need to be bundled together to be called basically and to be referred to as Swiss climate scores. Moving on to into the Excel sheet, we have a big section on input and coverage. This generated quite a lot of thoughts and work from the working group to understand how coverage basically plays. So assets in scope for now include mostly corporate bonds and equities, and it's definitely left to respondents to include other asset classes which they believe can be well represented. We know that some institutions also include private equity, etc., but that's initially not the spirit of the climate scores, but that's always feasible. So here, in terms of, we know that the availability of data is definitely an issue and also differ depending on the indicators. And the template really much allow now for a lot of granular information to be reflected on the coverage indicator as well as on the greenhouse gas emission indicators. The suggested threshold for eligible portfolio is 50% of the total portfolio, and that appears here. And as AMAS SSF, the working group basically recommended using the greenhouse gas emission coverage KPI as the proxy for the overall coverage of the scores. In each of the sheets of the templates, as a side note, we left in green basically what we've amended compared to the previous version for clarification. This has also been referred to, that's the big change, the big new indicator in the scores. So this overarching indicator referring to the overall investment objectives with regard to climate, basically showcasing whether the portfolio is aligned or contribute to the mitigation of climate change. As you can see, I mean, it's important to show the basis and the rationale for such an assessment. And the working group developed quite some example of possible rationales to be included as the basis of the assessment for the two questions. This is a new indicator, and this indicator is obviously is also optional. So that's the big one. Now, if we move to the rest of the sheet, greenhouse gas emission here, a few changes that are referred in green here, but I won't go too much into the detail. What's important here in this other current state indicators is the addition of beyond the exposure to fossil fuel, another indicator, so exposure to renewable energy has been added, and that's been adapted in the template as well, with the new formula, the new minimum criteria on renewable energy, and the explanations. What's important here to notice is that while we speak about the exposure to fossil fuel activities and to coal, and we refer to the current value of the investment, for renewable energy, we really look at the weighted average revenues. So that's a different way of calculating, and the templates actually capture that. Verified commitment to net zero, some slight wording change that's been adapted. Management to net zero is also the same in terms of the wording changes that have been incorporated in the template. And now, I mean, one of the key indicator was the credible climate stewardship. So engagement stewardship, lots of discussion here as well, because data is not always available. But that's still we capture the new way to look at credible climate stewardship with the share of votes that are on climate resolution that are voted in a manner that is consistent with the ambition of reaching net zero. And here, some of the changes, including adding reference to the Swiss Stewardship Code, also an initiative from AMAS and SSF, which also has a lot of good practice when it comes to stewardship. Finally, global warming alignment, which has not been facing a lot of change. So we kept basically the minimum criteria and the overall language that you can find from the SIF guidance directly. In terms of output data, you still are obviously able to capture it in the summary sheet, and that was critical. So in a nutshell, that's the template. As I said, we are definitely welcoming any feedback. And I just wanted to close by thanking all the experts of the working group that have worked really hard on putting this revision and this template together. You can see some of the names here. And with that, it's the great opportunity to pass it on to two of the experts that participate in the working group for a more concrete illustration of how they are using the scores today. So we'll start now. We'll start first with Ruben Feldman, and then we move to Barthélémy Simon. So Ruben, the floor is yours.
Thanks, Aurelia. So in terms of the implementation of our Swiss climate scores for Zurich Cantonal Bank Asset Management, the first question we had to ask ourselves was, well, do we do it at all? And if so, what is the scope of coverage on which we apply them? The coverage is firstly determined by whether the portfolio holds a significant amount or a relevant part of corporate investments. That's because obviously the Swiss climate scores are relative to corporate investments only. And so any product for us that has a significant amount of those holdings will have a Swiss climate score available. And that's irrespective of whether the fund in question actually has a climate directive implemented in the portfolio management strategy or not. And so the aim is to go for maximum transparency. If an investor is invested in a fund which is, let's say, a plain vanilla index replication, then there is also information about what the climate implications are, and it provides a comparison point between those funds and the funds that actually have more climate consideration implemented, such as a 1.5 degree or 2-degree alignment in the strategy. These are available, as you can see there. There's a snip from our website. We basically put it next to the fact sheet and our sustainability report. It's updated quarterly. And the idea is just to provide max transparency. We have it available in 3 languages. Italian will come at some point as well. And then if we go to the next slide, in terms of the challenges and the reasons why we implemented it, well, the first was determining the scope. And of course, to decide to apply them on funds that don't actually have climate consideration was a big decision. Obviously, you're showing funds that don't necessarily look good. And the idea is not to help sell the fund, but really to create a marketplace with more transparency and more customer awareness. We have a regulatory cost of reporting. So here, obviously, it's an optional regulation that we're complying to. But of course, once we comply with it, we have to follow the standards and adapt our data to fit the requirements. And so it's not just that we show a report with what we're doing, it's also we have to show what we're doing and how that fits within the framework of the Swiss climate scores. And that obviously has a cost. We've decided to bear that cost because it was worth the rewards. And then there were also some methodology choices which we had to make, and that was also created a little bit of a headache. There are some minor things like changing the base currency to Swiss francs, but then there are bigger things like choosing whether we use implied temperature rise or temperature alignment, as Aurelia has just described. This is an optional piece of the report. We decided not to use it, not to show it because we don't use it, and we don't believe that it adds value to show it because it's not used in the methodology. And similar with Scope 3, we had to kind of scramble quite quickly to get Scope 3 data that we could report on, even though we don't think the data is of sufficient quality to really use in asset management decisions for the time being. On the plus side, it has brought a lot of opportunities, especially when it comes to bringing more transparency and also help the client understand the implications with respect to climate of an investment in one fund or another. And we definitely hope that it will help shift assets towards more sustainable strategies, because when it comes to climate change, it should be all hands on deck because time is running out. Thank you.
Hello, everyone. So at Lombardier, we have also embraced the Swiss climate scores at the earlier stages. And the screenshots that you can see on the slides are taken from our website, from publicly available Swiss climate scores report that we publish for about 50 of our funds. And these reports have been available online since soon after the publication of the first version of the Swiss climate scores in 2022. We obviously produce similar reports internally for all of our mandates, and this was greatly appreciated by our clients who were seeking a reliable way to efficiently compare funds based on their climate change mitigation performance. So the publication of the Swiss climate scores was a huge step forward in that direction. As you can see on the right-hand side of the screen, no, thank you. We also publish the optional section, the section concerning the global warming alignment of funds using an implied temperature rise metric. We ardently advocated for the inclusion of this section and other forward-looking assessment sections during the discussions with the SIF as the scores were being developed. At the time, our vision of sustainability was already that of transition investing. Investing in decarbonization is simply not the same as investing in decarbonized assets. And therefore, standard backward-looking low-carbon strategies that focus on reducing financed emission fail to capture the opportunities presented by the climate transition. And the real opportunities lie in financing reduced emissions, which requires active stewardship, but also a forward-looking approach. And in that regard, the Swiss climate scores, in our opinion, perfectly encompass this vision, clearly bridging the gap between the portfolio current position, the current state indicators, and its transition to net zero with other indicators, such as the portfolio's ITR, so implied temperature rise. If we go into the next slide, I would now like to focus on the improvements that the second version has brought. And for us, the first and foremost improvement is the precision that the SIF gave on the GHG emissions calculation and its translation in the Excel template AMAS and SSF are publishing today. It's going to be very technical, but there are different manners to calculate both the carbon footprint and the carbon intensity of a portfolio, and more specifically, when assets are not covered, one method is to consider they represent zero emissions, while another excludes them from the calculation altogether. And what this means is that for the same portfolio, particularly if the coverage is low, the former will get a much lower figure. And in our opinion, this type of differences is undesirable, and the lower figure is purely artificial. So we are very pleased that this was standardized in the new version and in the updated template, particularly given the outcome that was chosen. And today, the Swiss Climate Score not only provide an excellent reporting template, they also include clear methodologies and definitions to enable an accurate comparison of the Swiss Climate Score's results coming from different asset managers. So we really welcome that, in particular since the alignment of the metrics with other, so there was also an alignment of the metrics with other regulations, such as the exposure to fossil fuel indicators, where the threshold was aligned to that of a similar indicator from the EU SFDR PIs. The main force of the Swiss Climate Scores remains the standard reporting template. This is truly what makes them unique. And therefore, aligning with other methodologies, with other best practices worldwide is very pragmatic, as it will help the adoption of and the understandability of the Swiss Climate Scores across the borders of Switzerland. Finally, the development of the templates that AMAS and SSF are publishing was also a key milestone in that adoption. We are also working internally on updating our online Swiss Climate Scores reporting tool, and the discussions that we have had will be key and will be very useful for that purpose. So we would also like to extend a warm thank to Aurelia and the entire team at AMAS and SSF for all their diligent work.
Well, thank you to these two practitioners for providing insights about how they apply Swiss climate scores today. And we now have the chance to dive a bit deeper and learn a bit more about the actual challenges, but hopefully also about the benefits of Swiss climate scores. My name is Sabine Döbeli. I'm the CEO of Swiss Sustainable Finance. And I would like to also take the chance to thank the whole work group that worked with us on preparing the new template. I have to say, when I look back at the point in time where we had the first idea of preparing such a template, I could never have imagined that it would end up in such a complex Excel sheets with so many detailed discussions to be led to define how exactly such KPIs should be calculated. So great to hear from practitioners that it actually makes their life easier in preparing meaningful reporting. And what I'd like to hear from both Ruben and Barthélemy is really, first of all, what has it changed for you in preparing data for your funds in the case of ZKB for all funds, in the case of Lombard-Odier, definitely for the sustainable funds. So how has it changed your reporting? Have you added additional indicators that you previously haven't covered? And which were the ones that you adopted on top of it? Ruben, can I start with you?
Sure. Well, the biggest one is Scope 3. So we don't use Scope 3 greenhouse gas emissions in our management because we estimate that the proxy risk is just too high. And by that, we mean that you could make an investment strategy based on Scope 3 and assume a certain company has a certain number of emissions. And it's usually based on an estimate because most of the universe is estimated. And then maybe 3 years down the road, the company gives you the actual emissions, which could be much higher, for example. And it basically means that you, having used that misestimation for 3 years, you've been greenwashing in essence. So we tried to basically compile a Scope 3 data set as accurately as possible from what has been available so far. And We're now showing it on our Swiss Climate Score, but we don't use it anywhere else. I mean, we have a similar issue with SFDR, which obviously has had a similar requirement with Scope 3. At least in the Swiss Climate Score, we have the ability to show it separately, which is hugely consequential because our methodology manages Scope 1 and 2. And if you bunch them all together, like as the EU's SFDR does, then Scope 3 has a much larger scale, which means that it tells people you need to focus on reducing Scope 3, which are not even real emissions. They're actually double counted Scope 1 and Scope 2 emissions. So we do benefit from that, but we've had some challenges with adding some data points like Scope 3.
Thank you, Ruben, for these insights. So definitely it helped you cover additional indicators, but also you were facing challenges related to that. I think it shows how such Swiss climate scores can also contribute to the discussion in the market.
Definitely, and raising awareness about potentially issues that need to be resolved, like understanding more about Scope 3 and in maybe certain industries where it's more relevant than others. And definitely in terms of stewardship as well, we've had a lot of benefiting transparency that came out of that. It sparked a whole discussion, how to differentiate types of engagements and types of votes relative to climate and whether it's really relevant. And pushing classification of data within our own systems to understand where resolutions, for example, might refer to a climate path for an underlying company, or whether it's more general and could potentially be a superfluous environmental issue that's discussed. So that's also been beneficial.
Thank you. Barthélemy, on your side, did Swiss climate scores lead to you applying additional indicators that you hadn't used before?
So most of the indicators present in the Swiss climate scores were to some extent part of our traditional sustainability reporting that we were doing for our clients for sustainable funds. So creating the Swiss climate scores report was more a question of aggregating all of them into a single place, putting them all in perspective. Well, contrary to what Ruben was saying, we were already reporting on Scope 3 emissions. We already integrated that as part of our standard report. Similarly, for the ITR metric, this is something that we have developed internally and that we report for the vast majority of our funds already. I think the only one that we didn't take into account was related to the stewardship part, where we had some challenges, in particular regarding the proxy voting indicator, the voting indicator related to climate votes, which has been clarified in this version. So we integrated the indication of companies under active climate engagement, which we actually added later down the road as part of our standard sustainability reporting. So I think this really brought the topic to light and kind of forced us to go into that direction and start reporting on engagement data as well already. And also the part related to the verified commitments to net zero is something that we didn't necessarily highlight as part of our reports, which we believe is a very interesting indicator because we know that everybody will not be able to use the ITR metrics. We know that the assumptions can differ between one data provider and another. So having something such as this indicator, which is already a forward-looking indicator, is very interesting for comparability across all asset managers.
Thank you for these insights. And just for the audience, please type your questions in the Q&A section. I will integrate them into the discussion. But before I do so, let me follow up with one or two other questions to the panelists. I'd like to know how much these KPIs, how much the Swiss climate scores have improved the dialogue with your clients and what role client advisors play in this. We often heard that the Swiss climate scores are still, although we only speak about the 6 indicators, now 7, are still relatively complex. How do you explain them to client advisors, and do they improve their dialogue based on them? Whoever wants to go first.
Sure. So actually, the most traction and discussion sparked by the Swiss Climate Score for us has indirectly been through the ASIP requirements, which are nearly entirely based on the Swiss Climate Scores. And this has been, I think, actually a very intelligent conversation where both sides of the conversation know what they're talking about. So it's given a real basis for a good conversation and maybe awareness of where certain weak points are of certain strategies or strong points of other strategies. With respect to, let's say, less institutional investors who are advised, there, I think the path is definitely longer. I mean, it's quite complex here. We're talking about, scope 1 and 2 versus scope 3, or forward-looking versus backwards-looking, and these terms often don't mean anything to the end investor. So there's still a long way to go. And it probably is not only just up to the client advisor to educate the client. There also probably needs to be some more exposure to these terms, just also as a matter of time and an exposure for the client. Yeah.
Okay. And how on your side, Barthélémy?
So I think for us, it's really contributed to democratizing and accelerating climate investing in Switzerland. Not only did this shed more light on the topic of climate change mitigation to all financial practitioners, this also established a common terminology, clear definitions, and I also think that this increased the level of understanding across the board. And afterwards, the discussions that we have had with our clients moved away from pure carbon footprint discussions to more sophisticated discussions with everybody being more educated and up to date on the topic. We really saw that there was significant progress in that direction, and this really accelerated the topic. I also think that it's a great opportunity for clients because, well, as I mentioned, there are several indicators where we will always have small differences because there will always be differences between the data providers. But I think today the gap has been bridged as much as it can. And the differences, the methodological differences are reduced to a minimum, which means that it's a great opportunity for asset owners and for everyone to set targets on all of these indicators and monitor them consistently. They can really set targets on their portfolios and be able to compare the data which are coming from different data providers. And I think it's quite unique in that regard.
Okay, I would want to switch to questions from the audience now as they start to pile up. And the first question is more from an operational perspective. Maybe you can both provide insights as to who has worked on these Swiss climate scores within your organizations. Was it the ESG department or was it the risk department? Who was responsible to prepare the Swiss climate scores?
For us, we have a sustainability department in asset management that's responsible for all of sustainability across all asset classes. And so we're responsible for that in that team. Of course, then there's huge collaboration between our IT, who is actually implementing it, and people in the middle in the specification, and of course, risk management as well as legal have a significant say in what gets in what and how it gets done.
No publication anymore without the legal department nowadays.
Yeah.
What about your side, Barthélémy?
On our side, it was also the ESG team, the sustainable investment team within the asset management of Lombardier, who developed all of that and who integrated all the data. Obviously, as Ruben mentioned, coordinating with other teams such as IT for going live and with legal to be able to publish all of that. And we coordinated between the ESG data team and other teams when needed, in particular for engagement or other indicators.
So in case someone doesn't have a large ESG team, what would you recommend? Which department should deal with it? Would it be the portfolio managers in collaboration with investment writing, or who should be involved?
It's difficult to know without knowing what else is missing in that organization. I mean, if you have a sustainability report, it would make sense that whoever's in charge of that would be in charge of the Swiss Climate Score.
Yes,
And if
completely.
not, then whoever's responsible for the fact sheet.
Okay. There are questions around indices. First, I'd like to start with the question if the benchmark reporting was mandatory under Swiss climate scores, as some funds are benchmark agnostic. According to my understanding, yes, it is the idea that you also have to report the benchmark. But what would you recommend for a fund that is benchmark agnostic on how to proceed?
You could use it. Yeah, go ahead.
No, on our side, I think whenever the fund was benchmark agnostic, we decided not to report on values for the benchmark. I think it was, from our understanding, it was purely optional to report on the benchmark, and most of the time the PMs actually think that it would be very artificial to select a benchmark just for sustainability data. So we decided to purely report the figures only for the portfolio.
And Ruben, on your side?
Yeah, I mean, it also depends whether, if there is no benchmark, is there still an index that's representative or not? If there is, then you could use it, but you would have to obviously disclose that it's not the official benchmark. It also depends if it's a multi-asset. I mean, sometimes it's also a question of that the actual benchmark rotates through time because it could be a dynamic allocation. So I think the key is to just be transparent and to try to make things that makes the most sense and be the most transparent.
Another question around benchmarks. So if you do decide to also report benchmark, the question is, do you already see a shift from benchmark providers that they naturally provide Swiss climate scores, get data to users? Or are you actually in a dialogue with them to obtain the data for specific indices? Or do you calculate them internally?
For us, we use our own data. So we have our proprietary scores, our proprietary data, and we estimate where it's missing using multiple data provider approach. So it would be difficult for us to use a pre-calculated number or set of figures from the index provider.
Yes, this is similar for us, and I will actually go a step further and say that for comparability purposes, we believe it is more accurate to use our own data so that we apply exactly the same methodology for our fund and for its benchmark, instead of depending on the calculation or the methodology or the data which is coming from the index provider, in case it's not the same data provider as we are using internally.
Which of course could become difficult if you have proprietary research for the companies that you cover in your fund but are not represented, or for those in the index that are not part of your fund, you wouldn't have the data then. How do you deal with such issues? So do you have all the data in-house on all the index components, even if they're not part of your funds?
I think that would be kind of a rare occurrence for us. If a component was in the index, it's very unlikely that we wouldn't have a coverage of some sort of it on it. Yeah. It could be the other way around, where we have companies that are out of benchmark.
I mean, linked to that is another question on how to solve the issue of no look-through holdings information on third-party funds. I guess that relates to fund of funds. I don't know if you at ZKB or Lombardier have already applied Swiss climate scores to fund of funds where you use third-party funds.
Yes, and that issue is definitely prevalent. Obviously, we strive as much as possible to get look-through data, and this is also relevant for many other types of reporting that we do. But when it's not available, then we obviously have to say that this is somewhere, it's a position where there is no data. And this is why also the Swiss Climate Score has specific information disclosure on the coverage, which is extremely relevant.
Okay. There are some quite technical questions on specific indicators. I hope you're prepared to take them. The first one is on the management to net zero. I mean, the management for this, or the management to net zero, there is no data provider on that. You sort of need your own assessment if a company actually, or if you as a fund manager manage to net zero. The question is, but from one year to the other, is it required to tell if you are following the target? I guess that would be a one-off decision, right? Either you decide that this is a fund that manages actively to net zero or not. So that would probably be quite a stable indicator. Is that correct?
Yes. In fact, if your portfolio just happens to be in line with a 1.5 degree target, by chance or by the result of a specific dynamic allocation, then I wouldn't say that you could claim that it is aligned to or managed in a way that is aligned to a 1.5 degree target. I mean, it has to be part of the prospectus. It has to be something that's contractually and a contractual obligation for the portfolio managers.
Mm-hmm. There are questions on two of the indicators, and I start with the second one here. How to handle the huge differences in Scope 3 estimations from different data providers. Probably Ruben has already given an answer, but Barthélemy, you calculate your own Scope 3 emissions, right? So
yes, so actually we use data from one of our data providers that we refine internally. So this is a slightly derived data that we use for all of Scope 3, but actually it's the same for Scope 1 and Scope 2. But as Ruben pointed out, Scope 3 data tends to have much larger differences than Scope 1 and Scope 2 because it's based on a lot of estimation and a lot of proxies. Even when reported by companies, actually they themselves have to estimate their Scope 3. It's never calculated or measured as precisely as it can be for Scope 1 and Scope 2. I think this is why also it's been a very nice addition. Well, not an addition, but it's one of the nice features of the Swiss climate scores is that we are supposed to report on Scope 1 and Scope 2 and separately on Scope 3. So I think this is why it's very interesting because having Scope 3 apart from the rest means that we can actually pinpoint where there would be differences between different asset managers. So if from different institutions, we do not have the same data simply because it's coming from different data providers and there are very large differences, it's still possible to set a target on Scope 1 and Scope 2 separately on the Swiss climate scores. But this still gives the idea of the magnitude of Scope 3 and of emissions which are implied within the supply chain of the companies within the portfolio, which for us is too big to go unnoticed, and which is why we decided that we should report on Scope 3 emissions.
Okay, thanks for these insights. Another question on climate stewardship. It's actually an interesting one. Why does the indicator ask for votes consistent with the ambition of net zero by 2050 instead of asking for being Paris aligned? Because there are many ways to be net zero by 2050 without being Paris aligned. Were we just imprecise in this indicator? Ruben, how do you deal with the different terms here? Net zero by 2050 versus Paris aligned.
I think it's a matter of trying to align meaning as much as possible. So of course, if you have a methodology that's not Paris aligned that enables one to reach 2050 net neutrality, that's great, but it has to be understood as such. And so what's important is that we all report on the same thing. And here the idea is that we try to align at least what the definition of a strategy can be. And even there's a lot of different ways that one can achieve that. And so at least here, there's some sort of standard definition attempt.
And of course, the implicit assumption is that you do not have strategies where everybody only reduces to net zero in the year one before 2050. But fair point. So a question on bond portfolios and revenues. So regarding to revenues from fossil fuels and the renewables indicators, do we assume that the bonds are exposed to the overall revenues of the firms, even if they have maybe specific bonds for green projects? How do you calculate that in the case of bonds? Who would want to go first?
I can.
Sure, go ahead.
I think the strategy, so it's something that we haven't fully developed yet, but I think in the template, the idea is to use to consider that the company, the bond is fully exposed to the revenue of the company, simply as a way of making a simple indicator and as aligning that with the requirements of the EU as well.
I think it could be it's one area where maybe there's space for further disclosure and improvement in transparency here, because obviously you try to make an indicator that tries to expose as much information as simply as possible. And obviously when you go into green bonds and it becomes project specific as opposed to firm, then the disclosure needs to be different. And so probably it would benefit from an additional set of disclosures on special bonds, not just green bonds either.
Okay, interesting. Now, another question is, do you think it would be necessary to develop an industry-wide database with climate scores, collecting data on all the funds that already apply the reporting, as this could help sort of, first of all, covering all target fund investments, but also it could, of course, help to build up a track record. And it relates to a question that I had prepared for you. Do you think we need to start working with this data and learning first how to interpret it? And would such a database help in doing so? What's your view?
Sure. I mean, this is also kind of the approach that SFDR has taken with the EET. This could also, I mean, it would help, but it also probably helps with comparability, that not PDF numbers have to be copied into an Excel sheet for each person that wants to make the comparison. So that could be a good idea.
Yes, I fully agree. And as I was mentioning before, I think for asset owners, it's also the Swiss climate scores are a key opportunity for setting targets and tracking their progress. So having such a database would, as Ruben mentioned, facilitate that work a lot for everyone across the board, I think.
Maybe a question to you. If you compare your sustainable funds and your non-sustainable funds, have you actually perceived a major difference with regards to the Swiss climate scores? Have sustainable funds performed better on the indicators than others?
Yes. So, well, our non-sustainable quote-unquote funds are index tracking. And so when you compare to the benchmark, there's basically no improvement because it tracks the benchmark. Whereas obviously our strategies that contain climate considerations outperform the benchmark considerably on those indicators.
What about Lombard-Odier?
Yes, so it's a case at Lombard-Odier as well. It depends obviously on the type of sustainability funds. Some of them are not related to climate, so we don't particularly see such an improvement in that direction. But the funds which are targeting climate change mitigation have all got much more carbon emissions reduction than their peers, and are already presenting better values in terms of fossil fuel exposure, in terms of global warming environment than their counterparts, which might not integrate such disclosures. We have also seen the number of verified commitment to net zero increase much more within these funds as well.
Okay, well, there's a question from the audience that relates to this, although in a bit different sense. Do your climate-friendly funds actually show a better return compared to traditional funds? I know it's a different level, but I think it would still be interesting to hear how your climate strategies have performed over the past few years, given the numerous crises in the energy markets we see in the world.
Well, firstly, I would say we haven't seen a strong outperformance of the fossil fuel industry since the different wars and so on have exploded. I think that this question can only really be answered by 2050 because that is the climate strategy that we're taking on. It's a long-term one. I can probably show you a bunch of funds that have outperformed and a bunch of funds that have underperformed because of climate or not on the short term. So I think it's very difficult to judge on the short term. And at least for us anyway, when you say traditional funds, the only traditional funds that we have that don't have any sort of climate consideration are plain vanilla index replication. So, we have a lot more that goes in than just climate. So it would be difficult to just show this on the basis of the Swiss Climate Score KPIs.
Okay. Maybe a last question around the signal to the outside world. How interested are non-Swiss clients in the Swiss climate scores? And are you using the Swiss climate scores also in client communication beyond Switzerland? Or are you limiting that to Switzerland for the time being?
We include that as well at Lombard-Odier for even non-Swiss clients. We have gotten some questions about the Swiss climate scores report that clients have seen and might not have understood what it actually stood for. I think, yes, outside borders of Switzerland, there hasn't been that much of an interest into the Swiss climate scores in advance. But when shown to clients, we have seen that actually clients recognize it's a very useful template for reporting on climate. So I think overall there wasn't a particular demand outside border initially, but once presented with that opportunity, clients were interested to look into that direction as well.
Glad to hear. So maybe Swiss climate scores can turn into an expert product as well. I'd like to thank the two panelists for the insights that they provided. We're already almost at the end of this webinar, and I allow myself to just close with a few closing remarks. I think we've seen, or we are always seeing almost every day, that climate change is becoming increasingly apparent, and we will most likely see more decisive policies to address both climate change mitigation and adaptation. And I think with this, transparency on climate risks and on climate impact is becoming increasingly important, both for clients, but it will also stay important for the regulator. We heard that both reporters find the mix of indicators referring both to current performance and to the contribution to the transition valuable. So we hope that this also paves the ground for fruitful client dialogue. I think something that market players need to keep in mind is that the Swiss government has actively decided against a taxonomy and has instead created these Swiss climate scores as a more open product. It is now up for the financial actors to use this opportunity and apply them broadly. As we heard by Christoph Baumann, based on our market study, we saw that already half of the reporters either apply them or intend to do so within a year. And I'm convinced that further market players will actually take up the scheme to prepare more transparency on their climate alignment of the funds. And a few years down the road, we can build on a solid track record with regards to the different indicators, and that will probably also enable both academics and practitioners alike to evaluate this data and come to clear conclusions about the significance of it, but also about the effects of such funds. With this, I'd like to say thank you. I'd like to say thank you to the speakers of this webinar. I'd like to say thank you to AMAS for the great collaboration in preparing the adapted template. And of course, I'd also like to say thank you to all those that were with us in today's webinar. And we look forward to being in touch again, both on climate and on other current topics in sustainable finance. Thanks for having been with us.